Hello and welcome to NDTV Profit, and you're watching Profit Insights. And joining me today is Vivek Paul, Global Head of Portfolio Research at BlackRock Investment Institute. Vivek, thank you very much for joining us on NDTV Profit. You know, we're going through a age where we are seeing a big disruption happening globally with respect to trade, and that's having an impact in terms of how stock markets are performing and various other asset classes are performing. As you look at it, how do you see the U.S. trade, rhetoric which is coming in from Donald Trump, impacting flows, and where do you see this getting settled?
Well, firstly, thank you so much for having me on. You're completely right. I mean, it's amazing to think that it's still in the month of April where we have had just material shift in the narrative in terms of the global trade dynamic. And we expected, of course, some material news and material rhetoric, but I don't think it's fair to say that many expected the extent of the volatility that we've seen. And you're right that it's shaping flows. And let's take India directly as an example. As we know, for a bunch of years, we saw material kind of inflow into Indian equities from foreign investors, which really started to sort of arrest something in the middle of last year, all the way through to the first quarter. And actually, what's really interesting is you look at the period of flows in the post-April 2nd announcements, and actually it's become positive again for foreigners in India. And I think that really goes to show that this is an environment where there's a relative game and there's an absolute game at play. Undoubtedly, in terms of the absolute scenario, this is an environment where we are going to end up with greater tariffs globally than we had in the past. That seems to be the clear direction of travel. But there's an enormous range of potential outcomes within that. And it is shaping the narrative. It is shaping the trade dynamic. It is shaping the opportunity set for international investors. If I think about our own positioning, our own sort of portfolio recommendations, where we started the year in terms of the sort of more broad Asian kind of complex, we had a near-term preference for China with a longer-term preference for India. As we've kind of come into the more recent period, we've softened that China preference. That's now neutral, given the particular impact of the trade dynamic and uncertainty on China. But we continue to reiterate that long-term opportunity set for India. And I think actually some of the structural benefits India can face in this environment is perhaps even accentuated by the volatility that we've seen.
How do you see trade shaping up with respect to India, given the fact that in the last 9 days alone, we have seen close to $4 billion of foreign flows coming into the country. And as you said, there may be a pause coming in because there's a trade reversal which is happening from China, and it could be flowing into other emerging markets into India.
Yeah, I mean, it's critical, right? I mean, I guess we've talked for a while, I think, about the idea that India has a unique opportunity in an environment of greater sort of global dislocation from an economic perspective, because it can play a role with both the United States and with China and really kind of insert itself more centrally into some of those global systems. And I think what we've seen over the course of the recent weeks is some of that starting to come true, right? We've seen the idea of major sort of manufacturers of telephones kind of thinking about using India more as a hub for some of that supply. We've seen Chinese exporters kind of think more about using Indian companies as a means of gaining access of their end exports into the American economy. So I think you're starting to see some of the dynamic we were postulating before coming through. I think that's one important point to make. I think there's another point I think implicit in your question, which is the ability, I think, of India to kind of come out of this with a relatively more favorable outcome. And you've seen comments from leading officials in the administration saying that they anticipate sort of progress with India and some of those trade talks to be accelerated relative to international peers. And that makes sense, because actually, if you think about the share of the sort of US imports that are kind of affected by this for India is comparatively small. The Indian economy is relatively resilient to this dynamic. And actually, structurally, from a sort of geopolitical perspective, it's probably an easier deal to be done with India, at least according to the US officials, than there is perhaps with China. So the ability to kind of make more material progress in terms of getting a deal, the starting point of the fact that there's less interconnection between India and America relative to India and China in terms of those supply chains, mean that perhaps we do see a more favorable outcome, and that will lead to more stories, like I started this answer talking about, of international trade being sort of rewired a little bit through India.
How does a portfolio manager look at it from the point of view of asset allocation? We're seeing Trump flip-flopping on announcements. There is a great deal of uncertainty which is coming into play. That's creating a volatility in place for a fund manager who's planning to allocate, through various geographies and asset classes. What should he be reading, and how do you see that translating into investments into geographies or asset classes?
Yeah, and this is the debate that we're all having in the asset management community, and I guess more broadly, investors at large. And I think one thing I would sort of caution against, I think trying to predict the next headline, the next kind of bit of news flow with regards to trade negotiation or whatever else it might be, with regards to the trading policies, is really hard. It's a fool's errand to try and understand exactly or try and forecast exactly the next step in a negotiation pattern. What I think we can do, though, is try and think, where are the boundary conditions, right? Where are the bigger kind of sort of dynamics, which mean that will prompt a reversal in a particular path or the rhetoric. And we're kind of framing this in the notion of thinking about the immutable economic laws that are actually going to govern what the end state looks like. And there's two that we particularly highlight. One is to do with the idea that you can't just, if you like, you can't just kind of change the terms of the trade deficit without having an impact on the foreign sort of flow and foreign funding of US assets. And I think we saw that sort of immutable law dynamic really coming into fruition right at the start of April, where we saw the 90-day kind of pause on tariffs come immediately after the fears in the treasury market of spiking yields. And I think you see there that the idea that the market forces of the yield movements kind of then influence the ultimate direction of travel of policy. I think you also saw some element of that when it comes to the second immutable law that we think about when we're trying to govern the space and navigate the space, which is the idea that the trading interconnected nature of the global economy has taken decades to build, and you can't just change it overnight without experiencing or anticipating some material economic damage. And I think when you saw in the course of the last couple of weeks the idea that leading CEOs were kind of pointing out to the world that there could be some impact here from kind of trying to change too much too quickly, you then again started to see some softer rhetoric come out, and therefore a bit more of a market rally in the course of the last week on account of that softer rhetoric. So trying to guess the very next move is really impossible. Trying to think about what are the bigger picture boundary conditions that can then influence the ultimate outcome, I think that is where we need to think a little bit more. And in that spirit, in that vein of taking that slightly bigger, longer term approach, that's where we see the opportunity arise in India, because the structural dynamics that we've been talking about for a period of time, the demographic dividend that India faces, the digitization of the Indian economy. These are structural drivers which we think it's important to focus on, because it can be very easy to get carried away with the very near term and only focus on, if you like, the very near-term tactical dynamics. We actually sometimes need to take a little bit of a step back, and that's where the structural opportunity lies. And the final thing I'll say in answer to your question, when we're building longer-run portfolios, for an international investor, we would indeed think a little bit more about holding a greater allocation to benchmark weight in Indian large cap equity.
So that's the conversation that Sajeet has had with Vivek Paul of BlackRock, where he's clearly indicating that limited direct exposure to India on the back of Trump tariffs is what you're watching out for, and maintains a neutral stance, at least for the next 6 to 12 months, believes that India stands out as a relative bright spot over the long term and sees greater than benchmark weights for large cap India equity. So that's a strong word coming in from BlackRock.